summer in the city, back of my neck getting dirt and gritty. Bend down, isn't it a pity? Doesn't seem to be a shadow in the city.
Welcome back, everybody. Oil prices under pressure once again this morning. Joining us to talk more about it is Tom Petrie. He is the chairman of Petrie Partners. And Tom, thank you very much for being here today.
Good to be here, Becky.
We have continued to watch oil prices. We talked to people about 6 months ago, and they said, as soon as oil production slows down and shuts down in some of these wells, you're going to see prices pick back up. That has not been the case. In fact, you're looking at WTI sitting just above $40 this morning at $40.08. What's going on?
Well, the decline in production in the U.S. has not come along as fast as people thought. It's about half as far down as we were first hearing. Even a month ago, there was this belief that U.S. production had probably contracted by about 600,000 barrels a day. It's less than half that at this point. And I think that's a big factor. That was a surprise. Even the government statistics were beginning to look like it was down, and then there's been some correction. I think that's the biggest single factor. And then also, we're also not seeing any change yet in either Russia or OPEC. So I think that's why you're hearing this lower for longer thesis. Mm-hmm. That said, the contraction in capital spending globally has progressed, and it's very hard for me to imagine we'll go through all of 2016 without seeing some real effects from that diversion of capital, because the embedded decline is out there, and I think we're going to see some effects probably by mid-2016.
Even though you're talking about a rebound in prices, you're not talking about getting anywhere near what we used to consider normal, $80 to $100. You're thinking that even if things rebound, you're talking about $50 for WTI by the first half of 2016?
I think that's right, Becky. Something like that, and then if you get back out to the end of the year and going into 2017, maybe we get into the $60 to $70 range.
And that is simply because there's just so much more oil supply than we've seen in the past, or is this a reflection of poor demand as well?
It's also a reflection that the industry is becoming much more efficient at developing oil at these lower prices. There's been a lot of innovation that's come along. The low prices have created the necessity to innovate and be much more effective. The other point there was a mention just a few minutes ago about the Goldman talk about a lower price. If we were to test into the 30s, I doubt we'll get as low as the $20 test, other than for a very brief time. But if we were to get that, it's in all likelihood going to create a real pressure on OPEC, because OPEC has a higher cost structure in general when you really factor in the cost to run their government, their security needs, and so on. And all of that would create a real catharsis, I think, within OPEC itself, and maybe create the path to a real focus on how to get to a more workable and sustainable price in that $50 to $70 range, somewhere down the road.
Tom, thank you so much for joining us today again. Tom Petrie.
Coming up, the race for the White House.